When I started practicing elder law back in the mid-1990s, long-term care insurance, there were about, well, probably over 200 companies that were selling long-term care insurance. And long-term care insurance can be a source to pay for long-term care. The way I always explain to clients is there are basically three ways to pay for care. One is using your own money. Second is long-term care insurance. And the third are government benefits, primary program being Medicaid, or for wartime veterans and spouses, VA benefits. But in the past 25 years, or nearly 25 years, long-term care insurance, or really what I call traditional use it or lose it long-term care insurance, the market has really dropped. Insurance companies have pulled out of it, and there's probably less than 10, maybe less than 5 companies that are offering traditional long-term care insurance. So a number of years ago, I went looking for the other alternatives because clients were calling our offices and asking, I have long-term care insurance, I just got a rate increase of 180%, what should I do? And I knew that insurance companies weren't just getting out of the market altogether. I had heard some word about the next generation of long-term care insurance, and I went looking for it and to educate myself about it. And I learned a lot about what we call creative strategies for long-term care. Also, we refer to it as asset-based long-term care. Now, the use it or lose it policies, the way they work, you pay a premium, and you're basically renting a bucket of money, which is paid out over a set period in terms of a daily benefit and over a period of time. It could be 2 years, 3 years, 5 years, lifetime, although companies really don't write lifetime policies anymore. But the problem is that the insurance industry badly mismanaged, didn't anticipate the payout on these claims, and by and large, we're losing a lot of money. And that has led to the next generation of products, what are called asset-based products. Now, some of these were made available or encouraged by the government under something called the Pension Protection Act, which was implemented in January of 2010, at least the long-term care provisions of that act. And one of the things that the Pension Act provides is that you can withdraw cash from life insurance or existing annuities tax-free to buy long-term care insurance, or you can completely exchange an existing annuity for a long-term care policy on a tax-free basis. Or you can also access funds from certain types of long-term care annuities at tax-free to pay for actual long-term care expenses. So what the government did was they really tried to incentivize and encourage people to buy long-term care insurance. So let me give you an example of what one of these policies might look like. So we have Bob, who is 70 years old. He's recently widowed, and his adult children live out of town. And he's got some health concerns. He's got diabetes with a history of heart disease. And he was turned down by traditional long-term care insurance. Now, Bob has $300,000 from the sale of a family business. He's got about $37,000 in checking, and he's got an annuity that he purchased for $100,000 that right now is worth $200,000. But as we know about annuities, they're tax-deferred investments. So the gain, he put in $100,000, it's worth $200,000, so he has $100,000 of gain, but he doesn't start paying tax on that until he pulls the money out of the annuity. So what Bob can do is take that $200,000 annuity and he can do a tax-free exchange into a Pension Protection Act annuity that can provide as much as 3 times the value of the current investment for long-term care. So he can take a dollar and convert it into being worth as much as $3 for long-term care. He can do that and pull the money out at about $8,100 a month for 6 years, 72 months, and that can be used to pay for home care, assisted living care, care in a nursing home, and when he pulls it out, he can pull it out all tax-free. What this does is allows him more coverage and thereby protect the rest of what he has, because if he's got the long-term care coverage, he's got this annuity to pay for care, that means he doesn't have to pull the money from his other investments to meet his care needs. When we see clients, and a lot of what we've done over the years is what I call the legal solution. Asset protection, making sure that somebody doesn't run out of money, that they're able to meet their long-term care needs, but also meet the other needs that they have, supporting, making sure that a surviving spouse has enough to live on, passing on a legacy to children, setting up a child that might have special needs. To be able to do that while paying for long-term care has for many years involved the use of trusts, putting assets into a trust. The client has access to them, but if we can plug in government benefits along the way, we do that and then supplement it with the assets that the client has, thereby assisting them in stretching their money out longer. Now, as we've seen the next generation of seniors, baby boomers, a large segment of the population has their assets, their nest eggs, their savings, a huge portion of it in retirement accounts, IRAs, 401ks. In some cases, 90% of their savings or more is in retirement. Now, we can't use the legal strategy of putting assets into a trust to protect them, because if we do that, we have to pull all of the money out of the IRA and pay a lot of tax without knowing at that time if the client will ever need long-term care and know whether it was even necessary to take that drastic action. Yet we can't wait to see if it'll happen, because we have to get through 5 years, known as the 5-year Medicaid look-back. So legal solution in those cases really doesn't work. And that's another reason why I went looking for the insurance strategies, the creative insurance asset-based strategies. And let me give you an example of a common scenario and where that could work very, very well. So we have Patty and Tim. Patty's 63, Tim is 68. Patty's frightened of the idea of going to a nursing home. Tim's not a fan of traditional long-term care insurance, and they would like to cover their care, but they also want to pass an inheritance on to their children as well. Now, their financial profile is they have $700,000 of IRA money, $37,000 in checking and savings, and $200,000 in stocks and bonds. So as you can see, probably about 90% of their money is in retirement tax-deferred accounts. So moving that money into trust doesn't work, because Tim and Patty would have to pay about 40% tax by pulling all that money out and putting it into a trust. So here's a possible solution for Patty and Tim. Tim's got an IRA of that $700,000. He's got, we take $250,000 in his IRA, and we transfer it, trustee to trustee transfer. That means we're not taking it out of an IRA, so he's not paying tax on that now, but we're moving it to a different product. It's still his money, but we're moving it to a different investment or insurance vehicle. And what it is, it's a life insurance policy with long-term care rider. And the idea of it is that it's going to cover long-term care. He can tap into it for long-term care if he needs it, But if he never needs it, then it will pay a death benefit under the life insurance policy, so that one of the things that people don't like about traditional use it or lose it insurance is that I might buy it, pay for 20, 30 years, and pass away without ever needing to tap into the policy. I will not have gotten any benefit out of that policy. This way, we're assured that the person's either going to tap into the policy for the long-term care, or if not, or for whatever is not used in that case, would be passed on as a benefit under the life insurance policy. And in this amount, just using an example, if we took $250 at Tim's age, that would convert to a death benefit on the second to die of $517,000. Second to die because the policy can also cover Patty as well. Even if the IRA is just Tim's, and this can be very beneficial where we have a married couple and only one spouse has the IRA, the other one doesn't have anything, but the one spouse's IRA can actually cover long-term care for both of them. It can cover care, in this example, $10,000 a month for Patty or Tim. It can cover home care, assisted living, nursing home care, and if they want to get their money back out of it, there's a 100% full refund of premium. So I always like to view it this way. If something better comes along down the road, then we can get out of that and get Tim and Patty into something else. And there's also an option to purchase a lifetime rider so that $10,000, it will be exhausted. There's a limited pool of $517,000, but for an extra premium of $2,000 a year, they can actually buy unlimited coverage if they so choose. And that $10,000 would be paid, obviously, for lifetime for Tim and for Patty. Keep in mind, these are just illustrations. Keep in mind that somebody might say, well, gee, I don't have $250,000 in an IRA. These are just illustrations. The numbers work. You just plug in the different numbers and it comes out with different benefits. There are a number of variables: the amount of money committed to the product, the ages and health of the applicants are all factors as well. And one final point is that for these types of products, often the underwriting requirement is a lot less strict. Whereas we've had clients that couldn't get traditional long-term care insurance, couldn't get through the underwriting. These types of policies have a little bit more relaxed underwriting, and in some cases, the age limits are a lot later in age as well. And the reason for that is because of the life insurance aspect of it and the fact that people are committing sums of money to these products so that the insurance company does have the benefit of using your money. It's still your money, but they have the benefit of using that money. And then the other final point to make is that on these types of products, when you tap into them, you are using your money first, but after your money is exhausted, then the insurance company will kick in their portion of the money. So let me summarize the differences between traditional, what I call use it or lose it insurance, and the creative strategies. So with traditional insurance, as I said, it's use it or lose it, meaning there's a bucket of money there. However, if you don't use it or you don't use all of it, even if you've been paying premiums for many years, the money goes away, it goes back to the insurance company. You can't pass it on to your heirs. Creative strategies, the asset-based products, you use it if you need it. If you don't use it all, or you don't use any of it, there is a death benefit that can be passed on to your heirs. So that's one difference. The underwriting process is a lot more strict in the use it or lose it the traditional insurance. A lot of the products in the asset-based world, they have a simplified underwriting, a modified underwriting process. So for some of our clients, they've been able to get the asset-based products where they might not. For example, I had a client we were able to get who had type 2 diabetes, was able to get one of these policies on the creative strategies. And then also, whereas on the traditional policies, by and large, by the time you're 75, most companies will not write coverage, or if they do, it is cost prohibitive. For many of the creative strategies, you can buy the policies up until age 80, or even in some cases until age 85. And then these policies differ from the government benefits. Qualifying for Medicaid, for VA benefits, they are needs-based benefits, so you have to jump through some hoops. You got to follow the government's rules. You have to spend down till you have nothing left in the case of Medicaid, only to find that you still might not qualify. So you're playing by somebody else's rules. Whereas with the creative strategies, you make the decisions without any government interference. So you go from impoverishment mode in terms of government benefits to empowerment mode. You make the decisions. You don't have to worry about, does this facility take Medicaid or not? You're not asking the government to pay for your care. So it's definitely an option. It's not the option for everybody, but increasingly it is for younger seniors.